There's a pattern in collapse, not a theory, not a prediction. A clock, a countdown that begins 18 months before every major financial breakdown in modern history, from 1929 to Japan 1989 to the global crisis of 2008. And each time, three signals appear, quiet at first, invisible to the public, impossible to ignore for those who understand the cycle. These signals don't warn you that a collapse might happen. They warn you when, because the truth is unsettling. Markets don't fall randomly. Empires don't unravel overnight. Systems don't fail without giving off the same three symptoms again and again, across decades, across continents, across different eras of technology, policy, and power. And the most disturbing part? All three of those signals are flashing right now. 18 months. That's the average window between the moment the first signal appears and the moment the system breaks. It happened in 1929 when corporate insiders quietly exited while the public rushed in. It happened in 1989 when Japan's asset bubble reached valuations detached from any measurable reality. It happened in 2008 when liquidity in the credit markets froze long before the public learned the word subprime. These weren't accidents. They were rehearsals of the same script. And today, as the global economy leans on unstable debt, artificial valuations, and historic levels of insider selling, the pattern is repeating with mathematical precision. This isn't fear, this isn't speculation, this is the sequence. And to understand what happens next, we need to step back, far back, to the first moment in history when these three signals aligned and triggered the collapse of an entire financial era. Because once you see how the countdown begins, you'll understand why it always ends the same way. To understand why these three signals appear before every collapse, we have to rewind, not by years, but by cycles, because collapses don't start with crashes. They start with prosperity. They begin in moments that feel safe, stable, predictable, moments when people believe the system has finally evolved past danger, when policymakers declare that recessions are manageable, that markets are efficient, that debt is sustainable. Every era has its version of this confidence, and every era pays the same price for it. Let's go back to the early 1920s. America had just emerged victorious from World War I. Factories were humming, wages rising, cities expanding. It was the first age in which ordinary citizens believed prosperity was permanent. But beneath the celebration, the gears of the cycle were already turning. Credit was loosening, speculation was spreading, and the first of the three signals quietly appeared, smart money exiting while the public flooded in. Nobody paid attention. Why would they? Everything felt strong. Fast forward to 1980s Japan, a nation rising from post-war ashes into an economic superpower. Their stock market surged. Real estate soared to levels so absurd that a single Tokyo district was worth more than all of California. Japan believed it had engineered a new kind of capitalism, stable, dominant, unbreakable. But beneath the optimism, the same three signals emerged again. Hidden shifts in credit markets, insider repositioning, valuations disconnected from reality. The countdown had begun long before the bubble burst. Then the 2000s. The United States stood at the center of global finance. Low interest rates, quiet inflation, limitless credit, home prices rising so fast that millions believed risk had disappeared. But the shadow banking system, an entire financial architecture most people didn't even know existed, began to fracture 18 months before the words Lehman Brothers ever made headlines. The same signals, the same clock, ticking toward the same conclusion. What ties these eras together isn't the technology, the politics, or the culture. It's the mechanism beneath them, a system that expands until the weight of its own leverage becomes unbearable. Every bubble convinces its generation they're smarter than those who came before. Every expansion disguises the danger building beneath it. Every collapse begins long before the crowd can see it. And once you understand the early signs, the pattern stops looking chaotic and starts looking inevitable. Which brings us to the core of this story, the historical proof. Because the three signals aren't theory. They've repeated with frightening precision across the greatest financial collapses in modern history. History doesn't give warnings, it gives patterns. And to see the three signals clearly, we need to step inside the three great collapses of the modern era. Three different nations, three different decades, yet the same countdown unfolding with surgical precision. Case Study 1, the Great Depression, 1929. The story doesn't begin with the crash. It begins 2 years earlier, in 1927, when the Federal Reserve quietly cut interest rates to support struggling European economies. Cheap credit flooded the American financial system. Banks loosened lending. Margin debt exploded. By 1928, the first signal emerged. Smart money began to exit. Corporate insiders, seasoned speculators, industrial magnates, they were selling while the public was buying with borrowed money. Joseph Kennedy, Bernard Baruch, the era's sharpest investors, liquidated months before the first cracks appeared. Then came Signal 2, liquidity distortion. Margin lending surged to levels no economy had ever tested. Banks borrowed from other banks to fund speculation. Corporations diverted their operating cash to the call money market instead of production. The system was no longer creating value. It was feeding a leverage machine. Signal 3 appeared next. Valuation dislocation. Stock prices rose nearly 300%, while corporate profits barely grew. A nation of factories was being priced like a perpetual motion machine. 18 months later, the market collapsed. The countdown had been exact. Case Study 2, Japan's Lost Decades. 1989, Japan in the 1980s felt invincible. Exports surged. Technology boomed. Real estate in Tokyo was valued higher than entire U.S. estates. But beneath the surface, the same clock was ticking. Signal 1 appeared in 1988. Insiders pulled back. Corporate executives, institutional funds, and keiretsu conglomerates quietly reduced exposure while retail investors poured savings into a market that seemed incapable of falling. Signal 2, credit distortion. Japan's banks engaged in something now known as convoy banking, lending to failing companies to prevent bankruptcies, propping up weak firms with new debt instead of letting the market reset. This kept the bubble alive, but guaranteed its destruction. Signal 3, valuation insanity. The Nikkei traded at 60x earnings. Land in Tokyo sold at prices implying infinite demand and zero risk. The economy was real. The prices were fantasy. And, just like 1929, the collapse arrived within the same window. 18 months after the signals converged, Japan didn't just crash. It entered a multi-decade stagnation, a warning to every nation that mistakes at the peak last longer than optimism ever imagines. Case Study 3, the Global Financial Crisis. 2008, the most recent rehearsal of the pattern began not with Lehman, but in 2006, when the first cracks in the U.S. housing market appeared. Signal 1, institutional repositioning. Hedge funds like Paulson & Co. and Scion Capital exited housing-related assets and quietly built positions designed to profit from collapse. Meanwhile, the public doubled down on real estate as if risk had vanished. Signal 2, liquidity fracture. The shadow banking system, mortgage-backed securities, repo markets, credit swaps began seizing up long before the public understood what they were. Liquidity was evaporating behind the scenes. Signal 3, disconnect from fundamentals. Home prices rose far faster than wages. Mortgage standards collapsed. Banks packaged toxic loans into AAA-rated securities. The entire market floated on assumptions no longer tied to economic reality. Again, the same timing. Signals converge. 18 months pass. Then the system breaks. 3 eras, 3 cultures, 3 economic systems, but the same blueprint appears every time. And that's what makes the present moment so dangerous. Because today, all 3 signals are not only visible, they're flashing brighter than they did in 1929, 1989, and 2008. The 3 signals aren't abstract ideas. They're measurable, quantifiable, and when they appear together, they form a sequence that has never failed to precede a major collapse. Today, each of them is not only present, it is reaching levels that exceed those seen before the Great Depression, before Japan's implosion, and before the 2008 financial crisis. Let's break down the pattern. Signal 1, the exit of smart money. Every collapse begins with the same quiet movement. The people closest to the system pull back. They are not reading headlines. They are reading balance sheets. They know the real numbers, the ones that never make it into quarterly earnings calls. And right now, their behavior is louder than words. Insider selling across the S&P 500 has surged to levels not seen since 2007. CEOs of major tech firms, Bezos, Zuckerberg, Diamond may have been unloading billions in stock while reassuring the public that growth remains strong. Warren Buffett is holding record cash reserves, the largest cash position in Berkshire Hathaway history, a move he only takes before deep market resets. Hedge funds are building positions that only pay off if liquidity evaporates, the same positions we saw in 2006-2007. This is not diversification. This is not routine selling. This is exit strategy. The first signal has appeared, and it is unmistakable. Signal 2, liquidity fracture. Liquidity is the invisible oxygen of the financial system. When it thins, systems look stable from the outside, but become dangerously fragile from within. In every historic collapse, liquidity breaks before prices do. And today, the fractures are widening. U.S. Treasury market depth, the cornerstone of global finance, has fallen to its weakest level since the pandemic panic of 2020. Money market funds are absorbing trillions, starving risk assets of capital. Corporate bond issuance is slowing, while rollover needs are accelerating, a deadly mismatch. Banks are tightening lending at the fastest pace since 2008. The shadow banking systems of private credit, structured products, non-bank lenders is showing the same early stress indicators that preceded the subprime meltdown. Liquidity is shifting from risk to safety at an accelerating rate. This is the second signal. The bloodstream of the system is constricting. Signal 3, valuation dislocation. The third signal is always the same. Prices detach from reality. In 1929, stocks soared while earnings stagnated. In 1989, Japanese land prices implied infinite demand. In 2008, homes were priced for borrowers who didn't exist. Today's disconnect is larger than all three. The Buffett indicator, total market cap to GDP, sits far above the 120% danger threshold. It now floats near 185%, higher than the dot-com bubble. AI-driven valuations have added trillions in market cap without matching profit growth. Meme stocks revived a speculative impulse reminiscent of late 1928. Real estate in major U.S. cities still trades at valuations impossible to justify with rental income or wages. Corporate earnings growth is slowing, but valuations keep rising, the classic late-cycle divergence. This is the third signal. Asset prices operating in a world the real economy cannot support. And once all three signals overlap, the countdown begins. The convergence, smart money exit, liquidity fracture, valuation dislocation, independently. Each one is dangerous. Together, they are catastrophic. In 1929, they aligned. 18 months later, the Dow collapsed. In 1989, they aligned. 18 months later, Japan entered a lost generation. In 2008, they aligned. 18 months later, the global financial system froze. Today, they have aligned again, not quietly, not partially, but completely, which raises a question we can no longer ignore. If the same signals that preceded every major collapse in modern history are flashing right now, what does that say about where we stand today? The pattern didn't end in 1929. It didn't end in 1989. It didn't end in 2008. It evolved. And today, all three signals aren't just visible. They're amplified by a world more leveraged, more interconnected, and more dependent on centralized liquidity than at any point in human history. If the collapses of the past were earthquakes, this one looks more like a fault line stretching across the entire global economy. Let's connect the pattern to the world we live in now. 1. The smart money exit, now global, not local in previous cycles. Insiders were national. American industrialists in 1929, Japanese conglomerates in 1989, U.S. bank executives in 2007. But today's insider class is global, and they're all signaling the same thing. U.S. corporate insiders are selling at the fastest pace since 2007. European executives are reducing equity exposure, citing unmodeled risk. Chinese elites are moving wealth offshore at the highest rate in a decade. Middle Eastern sovereign funds have quietly rotated trillions from public markets into private credit, cash, and strategic assets. The wealthy aren't diversifying. They're preparing. And preparation on this scale is not coincidence. It's confirmation. 2. Liquidity fracture. The system is thinning everywhere for the first time in modern finance. Liquidity stress isn't concentrated in one sector. It's appearing across the entire system. U.S. Treasury liquidity is weakening despite massive government issuance. Europe's banking system is tightening credit even with low demand. China's shadow banking sector, once a $60 trillion engine, is contracting violently. Global shipping costs are swinging wildly, a sign of supply chain fragility. Commercial real estate refinancing needs are exploding in every major financial center. Liquidity isn't just weakening, it's splintering. And when liquidity splinters, the system becomes brittle. A shock that once would have bent the system now risks breaking it. 3. Valuation dislocation, a disconnect larger than 1929 and 2000. Combined, every collapse is preceded by a belief that the world has fundamentally changed, that old metrics no longer apply. Today, that belief is stronger than ever. Artificial intelligence has become the new justification for infinite valuations. Investors are pricing companies not on earnings, but on potential. The same psychology that drove Japan's real estate bubble, the dot-com mania, and the 1920s melt-up. Consider the scale. The U.S. high-risk market has added over $12 trillion in valuation in 2 years without corresponding earnings growth. Some AI-linked firms trade at price-to-sales multiples above 30, levels unseen since the peak of the dot-com bubble. Real estate in major U.S. and European cities remains unaffordable even as demand falls, a classic late-cycle divergence. The market is behaving as if economic gravity has been suspended. History shows what happens next. 4. A more dangerous world. Technology makes the cycle faster. In 1929, panic spread by newspaper. In 1989, by television. In 2008, by financial terminals. Today, panic spreads in milliseconds. Algorithmic trading amplifies volatility. Social media accelerates contagion. Retail investors can liquidate in seconds. A single rumor can erase billions before any human intervenes. The countdown is no longer 18 months by necessity. It's 18 months by precedent. But the next collapse could unfold far faster. 5. A geopolitical overlay. The first multipolar financial cycle. Unlike previous cycles, the world is no longer operating under one dominant power. The US dollar is strained. China is over-leveraged. Europe is aging. Emerging markets are fragile. The system isn't anchored by stability. It's suspended between vulnerabilities, which means the collapse of one major economy no longer triggers a domino effect. It triggers a chain reaction, the convergence of 2825. When we place today's environment over the historical blueprint, one conclusion becomes inescapable. We are not early in the cycle. We are late, very late. The 3 signals are here. They are synchronized, and they are accelerating. If history maintained its 18-month countdown through eras of slower communication, lower leverage, and isolated economies, what happens now? When the world is maximized on every front, that leads us to the final step in the sequence. The point history always converges toward. Collapse never looks like collapse in the beginning. It looks like confidence. It looks like rising markets, strong earnings, optimistic forecasts, and leaders insisting everything is under control. Then the pattern tightens, the signals align, and the countdown reaches 0. Every system in history that ignored these 3 signals met the same fate. They broke not from a single event, but from accumulated fragility, finally expressing itself. The United States in 1929, Japan in 1989, the global economy in 2008. Different cultures, different structures, different eras, but the same mathematical arc. A system expands, confidence accelerates, leverage multiplies, liquidity thins. Insiders exit, prices detach from reality, and then, inevitably, the weight becomes too great for the structure beneath it. The collapse is never the cause. It is only the consequence. And today, that consequence is approaching, not because of fear, not because of headlines, but because the pattern has completed its cycle. Again, smart money is already out. Liquidity is already fracturing. Valuations have already lifted into a realm the real economy cannot support. The signals are not forecasting the future, they're describing the present. And once all 3 appear together, the system has never stabilized. Not once. Not in any economy. Not in any era. History doesn't repeat itself by accident. It repeats because human behavior does, because incentives do, because the architecture of debt, speculation, and optimism hasn't changed, only accelerated. That's why this moment feels familiar, because it is. The same countdown that preceded every major collapse of the last century is running again. And this time, the world is larger, faster, more leveraged, and more interconnected than ever before. The pattern is not a warning, it is a verdict. And we are already living inside its final phase.